Hey friends, welcome back to the channel. I'm Eve Barrett, the Cabin Fairy, licensed real estate broker, property manager, and your mountain market translator. Today we're talking about something that surprises a lot of investors. Home prices have skyrocketed since 2020, but nightly rental rates, not so much. And that gap, that's where expectations and reality are colliding in the short-term rental world. Let's sprinkle some clarity on this. Let's rewind. In 2020, interest rates were historically low. We loved that. Inventory was tight. Demand surged. People fled cities. Remote work exploded. Housing prices in many markets doubled, and in some vacation destinations even tripled in 5 to 6 years. But here's what didn't triple: the average nightly rate of a short-term rental. In many markets, nightly rental rates have stayed relatively flat, maybe up 10 to 20% in some areas, but nowhere near housing inflation. So now we have purchase prices way up, nightly revenue relatively stable, and the math matters. Pre-2020 investors had lower purchase prices, lower interest rates, lower property taxes based on their values, smaller monthly payments. So when they charged $250 to $400 per night, it covered their mortgage. Many properties truly paid for themselves, so even cash flowed beautifully. That era created a narrative. Buy a short-term rental, it will cover itself. And for a while, it did. But today, the numbers look entirely different. Fast forward to today, we're seeing higher purchase prices, higher interest rates, increased property taxes, higher insurance premiums, increased labor costs, increased utility costs, higher management fees because service standards rose. But nightly rates, they are limited by market competition, guest price sensitivity, platform algorithms, and supply saturation. Guests will only pay what the market supports. You cannot simply triple your nightly rate because your mortgage tripled. The market does not care what you paid for the house. It cares about value. So here's the big mindset shift I see. New investors often say, I just need it to pay for itself. But what does that mean? The mortgage, property taxes, insurance, utilities, maintenance, management, CapEx reserves, furnishings, and turnover costs. When you stack it all together, break even is much harder to achieve at today's purchase prices. This is a shock moment for many new buyers. The cabin doesn't magically cover the spreadsheet. It must be purchased strategically. Short-term rentals today are a lifestyle investment. They're long-term appreciation plays. It's a business, not a passive side hobby. If you're buying in 2025 or 2026, you need a strong down payment, conservative projections, realistic occupancy assumptions, clear understanding of seasonality, and a buffer for those slower months. The era of put 10% down and let Airbnb handle it is largely over in many markets. Now it requires intention. Not all. It just means you buy smarter. You underwrite conservatively. You stop assuming the property will magically pay for itself. Many properties still perform beautifully, but the purchase price must align with the revenue reality. The fairy dust works best when the math works first. So here's what I tell my clients. If the numbers only work in a perfect year, they don't work. Short-term rentals are still powerful wealth-building tools, but today they require clarity, they require discipline, and realistic expectations. Because in this market, magic follows strategy, not the other way around. If you're thinking about investing in a short-term rental and want real numbers, not Instagram hype, drop a comment or reach out. And if you're already in the STR space, tell me, have your numbers changed since 2020? Let's have the honest conversation. I'm the Cabin Fairy, and I'll see you in the mountains.